Hey everyone, and welcome back to another stock market Q&A video for this month of May. As always, thanks everyone who was able to ask a question on the post that I made on the community board. And if you're watching this for the first time and you're wondering how you can get a question in this video, then the first thing that you need to do is you need to hit the subscribe button, hit the notification bell so you get notified when I post. And essentially every month I make a post on the community board on my channel. It will appear in your subscription box if you're subscribed, and you can ask your question there, and then I usually select 5 or 6 questions and go through them and answer questions for about 15 minutes. So without further ado, let's get straight into the first question. So the first question that we have here today is if you had $2,000 right now to put into any ASX share, which 2 shares would you buy? 1, a passive long-term goals, and 2, a short-term aggressive. Okay, so first of all, to cover the short-term aggressive stock, I don't do any I don't invest and make any investments in businesses to make short-term profits. I don't make any aggressive high-risk trades to make profits in the short term. I don't make high-risk long-term investments. So if I had to pick what to do with 2,000, I certainly would not be putting it in something, trying to make a gamble or make a bet that I can pick a business and know where its stock will be in a month's time. Especially with how volatile the market has been this year in particular, and how fragile the current market conditions are. No one really knows what's going to happen, when everyone's going to go back to work and go back to just living a normal life rather than being in lockdown. There is so much uncertainty, and that uncertainty will dictate stock prices in the short term at the moment. And I don't know how to predict that. In terms of long-term businesses, honestly, if I had a spare $2,000, for example, if I am receiving my $2,000 that I set aside from my income from my business, and I had to decide right now what to invest in, I would be keeping it in cash right now. And the reason why is because none of the businesses that I deeply understand are at prices where I'm ready to either add to those positions and build them up more, or if it's a new business that I don't hold, they have yet to reach a price in which I think I can confidently make a good return. So I mean, I say if I had $2,000, that it has really been the case throughout April. The market basically just went back up to where it was pre all of this virus event sort of thing. So I've just been stockpiling cash since the market has sort of bounced back up. And if it goes back down again, I will take that opportunity to buy more shares like I did quite heavily in March. But other than that, I'm going to be holding on to my cash. And that's really because I only make investments when I feel that the prices of those businesses are where I can very confidently make a decent return and that the downside is very limited. The next question that we've got here is, can you explain the difference between cash flow from operations and net profit? Yeah, so the major thing that you should think about when we're talking about the profit figure that's on the income statement versus the cash figure, cash from operations on the cash flow statement, is that one is talking about cash. When has cash come into the business? When has cash left the business? Whereas the profit figure is supposed to give us a financial position of the profit or the losses for that company in a given period. And there's really 2 major differences. One is sometimes a business earns revenue in a different period to when it receives the actual cash. So, for example, if you have a cruise business, they receive the cash from customers up front when they pay for the services. Whereas it will become profit on the income statement, they earn it when the person has been on the cruise, when they've performed the obligation. Okay, so that's one difference. And the other difference is that the income statement profit figure will include non-cash charges, things like depreciation, amortization, that are not real expenses. They're just non-cash expenses that are supposed to represent the changes in value of assets on the balance sheet. Whereas cash flow from operations focuses on the true cash flows of the business, how much money the business actually spent on expenses and how much money cash the business actually received. The next question we've got here is, I would love to see you explain the terminal value from your discounted cash flow model a bit more. Is terminal value an approximation of cash flows into perpetuity, or just years 10 to 20, or something else? In your net present value formula, it seems like we're calculating the terminal value of cash flow for owners if all of it was achieved in year 11, which is a bit confusing. Thanks, keep up the amazing videos. Yeah, so the general idea of a terminal value is to represent all of the cash flows into perpetuity until the business no longer ceases to exist, no longer exists, but starting at the point beyond reasonable estimation. So I believe that over a 10-year period, you can come up with a reasonable growth rate and figure out what those cash flows might be for the next 10 years. But beyond 10 years, it gets very difficult to predict what those cash flows will actually be. So we want to come up with a figure that represents, a conservative figure that represents all of the cash flows that the business receives after that point. And in my spreadsheet in the discounted cash flow, I use a terminal multiple, which means that I'm taking the 10th year cash flow and I'm adding a multiple to it. In my spreadsheet, it's a multiple of 10. Okay, and that's one of the methods you can use for calculating a terminal value. The most probably accurate method, I would say, is something like a perpetuity growth terminal value model. I'm not actually sure what the correct name is just off the top of my head, but some kind of terminal perpetuity formula, which would give you a better representation of the cash flows after and beyond where we can reasonably estimate. And terminal value is a whole topic in of itself, and I've been saying for quite some time I was going to make a video on terminal value, and I kind of just forgot about it for a while, but it will be a topic that I cover in depth, and there will be changes made to the spreadsheet so that people can use whichever version of the terminal value they think is most appropriate. So you can expect that in the future, and I know I think I said that even in the last Q&A session, but it is coming, and I will do a video covering all of the different types of terminal value and the pros and cons of using each one. The next question that we have here is, how do you calculate a fair buying price for a stock given the uncertainties in future earnings while the economy is locked down? Yeah, so the first thing that we need to recognize is that the earnings for companies in 2020, for most companies at least, is going to be not typical. It's going to be either substantially lower, or if it's a high growth company, maybe their growth will just slow down during that period. So we need to recognize that this short-term period, maybe it's just 2020, maybe it's 2020 and 2021, but there are going to be, in the short term at least, periods where earnings and revenues and profits and that sort of thing are not typical. So when you're analyzing businesses, and this goes for right now, and when we were analyzing businesses a year ago, we always need to recognize that when we're projecting cash flows over a 10-year period, there is almost certainly going to be at least one time where earnings drop substantially, where there is weak economic conditions. And whenever I've been analyzing companies, let's say last year, for example, and I was using 2018 numbers or 2019 numbers and projecting forward, I always knew in the back of my mind that throughout the next 10 years, from 2020 to 2030, that there would be at least 1 or 2 years where cash flows would drop off. And therefore, when I'm projecting from 2018 or 2019 earnings, I have to be very, very conservative in the numbers that I'm using to project forward, the growth rates that I'm using. And I guess an example of this would be the way that I model out Thor Industries. So Thor Industries has a couple of things going for it. Well, the negative thing is that it's quite a cyclical business. So when there is weak economic periods, their earnings and revenues get slashed quite substantially. But on the positive side, if you look over the past 10, 15, or 20 years, their growth has been about 10 or 15%, even over a period as long as 15 or 20 years. But given that I recognize that there was going to be some kind of downturn in the short term that would impact their revenues and profits and cash flows ultimately, the growth rates that I was most confident in using to project the business were in the range of 4 to 6%, even though their past growth had been 10 or 15%, even over very, very long periods of time. So the way that you approach it is to be very conservative. And the other thing that you can also do is you can take an average of cash flows over the past 10 years and use that as your starting cash flow. So that will also help you to avoid making the mistake of taking the highest earnings for a company, which for many companies happened in 2019. You can avoid making the mistake of taking that really high earnings number and then projecting it into the future and expecting to continue to see growth without any decline. Take an average and use that as your starting value, and then project growth from the average of the past 10 years. And as a result, of course, earnings are not going to, or cash flows, I should say, are not going to grow in the future in a straight line like it shows us in the discounted cash flow. But that straight line is supposed to represent a conservative model that allows for the fact that earnings will go down and then they'll go back up again. So for really great companies, that is at least. So that's a couple of things that you can do. Be very, very, very conservative in your numbers. And or take an average over the past 10 years to get that starting cash flow. And both of those things will help you to not overestimate the amount of cash that you can get out of a business. The next question that we have here is, hello from upstate New York. My question is, do you foresee another stock market downturn given there are so many economic problems that the market is ignoring? And what would be the best course of action depending on whether you see another downturn or not, given the current circumstances? Yeah, so in terms of the short term, I don't know. I always have this position where I don't know what is going to happen in the short term. And that's kind of the nature of what is happening right now. We had a crash. I didn't know when that crash was going to happen specifically, although because businesses were expensive, I wasn't making investments, and that's kind of how I was able to navigate that. Fast forward another month, stock prices have kind of gone back up, and again, businesses are expensive again, even though economic conditions seem to have continued to worsen. And as a result, I'm not investing again. And that's kind of been my experience. So basically, I don't know what's going to happen for the remainder of the year or the next 2 years. But if the market goes down again, then those great businesses will be cheap again and I'll invest. And if they don't, and the market just roars on from here and economic conditions improve rapidly, then I won't be adding more to those positions, and those positions will go up in size. And that's kind of the way that I've approached it. I don't make predictions about what the market is going to do in the future, in the short term. I just care about the business and what I think it can produce. And based on what it can produce for me, how high the stock price can go in the future conservatively, and what are the share repurchases going to be, and the dividends, all of those things combined. And based on that, I'm able to come up with a conservative price that I'm willing to pay. And if the business isn't at that price, I let my cash build up. If it does get to that price, I invest in it. And that's going to be what I will do for the remainder of the year. But in terms of what is going to happen, whether I'm going to get the opportunity to invest more, I have no idea. And frankly, nobody has any idea. And the final question that we have time for today is from Brent. So, hey Hamish, I have a question about insider trading. Facebook has incredible numbers and it looks like a great stock to invest in when it goes on sale. One red flag I've found is all the recent insider trading, especially from the founder Zuckerberg. He sold close to 2 million shares since September 2019. What is your opinion on the insider trading? Yeah, so, I mean, in terms of Zuckerberg specifically, yes, he's been selling the stock, and that typically you want to see that the management team is investing more money into the stock. But I think Zuckerberg holds close to 400 million shares. So to sell 2 million shares isn't as if he's dumping his position or anything. What would 2 million shares would put that at about maybe $400 million, which sounds like an outrageous amount of money, but he has over $60 billion in Facebook stock. So, in terms of that specifically, that doesn't concern me too much. It's not really whether a CEO is selling stock in of itself. It's really in relation to, or relative to, I should say, how much of their stock that they hold. Is he building a huge position in the company, or is he dumping a ton of his stock? Has he sold 5 or 10% of his stock? In this circumstance, it looks like he's sold about 0.5% of his holdings. So he's trimmed it a little bit, and that honestly doesn't really surprise me. I mean, he may very well have something specific that he's using with that money, and that's not something I'm too concerned with. But on the topic of insider trading in general, typically the one big red flag that I try to avoid is if the management team, if the executives are selling large amounts of stock, so as I said, relative to their position, so they're trying to get their wealth out of the company at the same time as the management team repurchasing stock. That's something I hate to see because it shows a distinct disalignment between the management's personal opinions about the business and what they're willing to do with shareholder money ultimately, which is when they're repurchasing stock, they're using cash, which is really the shareholders' cash. It's the owner's cash, and they're using it to pump up the stock price at the same time as them selling their own stock. That's something I don't like to see, but in terms of this specifically, it's such a small amount relative to his overall position that it's not something that I'm too worried about. So those were the questions that we had for this week. And again, thank you very much for everyone who posted a question. And I apologize if I was unable to answer your question this month. But as I said, I do these every single month and I've been doing that for quite some time. So if you subscribe, you can ask a question by being subscribed, hitting the notification bell, and then on the community board in about 4 weeks' time, I will be making a post and you can ask your question there. And if you have notifications on, you will be notified when I make that post. But I hope you guys enjoyed this video. Let me know your thoughts on the questions, or if you have more questions down in the comment section below. Leave a like if you enjoyed it. And other than that, I hope you guys have a great day, and I'll see you in the next one.